Hello and welcome. Before we begin, I need to share something important with you. Everything you're about to hear is general information only. It is not personal financial advice. Your situation is unique. Always speak with a licensed financial advisor or Centrelink directly before making any decisions about your retirement income. Now, let's get started. Are you making these 5 costly Centrelink mistakes? If you're over 50 and you're watching your savings, wondering if you've got enough to last, this question matters. It matters deeply because the mistakes we're going to talk about today aren't small. They're not about saving a few dollars here and there. These are mistakes that can cost you thousands, even tens of thousands of dollars over the course of your retirement. Money you've worked hard for, money you deserve to keep. I want you to know something right now. If you've already made one of these mistakes, you're not alone. You're not foolish. You're not behind. The system is complicated. It changes, and most people were never taught how to navigate it properly. So take a breath. You're here now. You're learning, and that's what matters. Let me tell you what I see every single week. I speak with people just like you. People who worked hard their entire lives, people who paid their taxes, raised their families, contributed to their communities. And now, in what should be the most peaceful chapter of their lives, they're stressed, they're worried, they're lying awake at night wondering if they'll have enough. And here's the heartbreaking part. Many of them are missing out on money they're entitled to, money that could ease that worry, money that could let them sleep soundly. Money that could mean the difference between just surviving and actually enjoying these precious years. So today, I'm going to walk you through the 5 most costly Centrelink mistakes I see. We're going to take our time. We're going to go deep because you deserve to understand this properly. You deserve clarity, and you deserve every dollar you're entitled to. Let me start by asking you a question. When you think about Centrelink, what comes to mind? For many people, it's confusion, frustration, forms that don't make sense, rules that seem to change, phone calls that take hours, endless hold music. And I understand that, I really do. But here's what I want you to remember. Centrelink is not your enemy. It's a system designed to support you. The problem is, it's a complex system, and if you don't understand how it works, you can easily leave money on the table. Or worse, you can make choices that accidentally reduce your entitlements for years to come. So let's talk about how we got here. Let's talk about the Australian context, because understanding where we've been helps us navigate where we are. Think back to the Australia of 30 or 40 years ago. If you're in your 60s or 70s now, you remember it well. Back then, the age pension was simpler. Most people worked for the same company for decades. Many had defined benefit pensions, guaranteed income for life. Superannuation wasn't even compulsory until 1992. The safety net was different too. The cost of living was lower, relatively speaking. A modest home in the suburbs was affordable on a single income. Healthcare was less expensive. University was free for many Australians. You could retire at 60 or 65, and the pension was enough to live on comfortably, especially if you owned your home outright. But things changed, slowly at first, then faster. Superannuation became compulsory. That was good in theory. It meant Australians could build their own retirement savings, but it also shifted responsibility. Instead of employers providing pensions, you were now responsible for managing your own super, and not everyone was prepared for that. Then came the asset tests, the income tests, the deeming rates, the gifting rules, layer after layer of complexity. And each new rule was designed with good intentions, to make sure public money went to those who needed it most. But the result was a system that became harder and harder to navigate. And here's what happened. A generation of Australians found themselves caught in the middle. You'd saved diligently into your super, you'd maybe paid off your home, you'd done everything right. But now, as you approach retirement, you're discovering that those savings might reduce your pension, or that selling your investment property could push you over a threshold, or that gifting money to your grandchildren could affect your payments for years. The rules weren't explained clearly, the consequences weren't obvious, and so good people, people like you, made decisions without understanding the full picture. Add to that the economic pressures of today, inflation that we haven't seen in decades, interest rates that climbed faster than anyone expected, energy bills that doubled, grocery prices that keep rising, insurance premiums that seem to go up every year, and suddenly that retirement you'd been planning doesn't feel quite so secure anymore. This is the Australia we're living in now. It's different from the one we were promised, and that's not your fault, but it is your reality. And the good news is, once you understand the system, you can work within it. You can make choices that protect your entitlements. You can avoid the costly mistakes that others have made. So let's get into it. Let's talk about these 5 mistakes, and I'm going to explain each one carefully because this matters. This is your money, your security, your peace of mind. Mistake number 1, not understanding the asset test. This is the big one, the mistake I see more than any other, and it costs people dearly. So let's break it down, nice and slow. When you apply for the age pension, Centrelink looks at 2 things, your income and your assets. They calculate your pension entitlement based on both tests, and you get whichever amount is lower. That's important. You don't get to choose. You get the lower amount. Now, most people understand the income test reasonably well. If you're earning money from work, or getting rent from an investment property, or receiving dividends, that's income. It reduces your pension. That makes sense to most people. But the asset test, that's where it gets tricky, because assets aren't just things that earn you income. Assets are things you own. Your car, your furniture, your savings account, your shares, your investment property, even your caravan, all of it counts. Well, almost all of it. Your family home doesn't count. That's the big exception. If you own the house you live in, it's exempt from the asset test. And that's significant because for many Australians, their home is their biggest asset. But here's where people get caught. They think, I've got my home, I've got $100,000 in super, I'll definitely get the full pension. And then they're shocked when Centrelink tells them they're only entitled to a part pension, or sometimes no pension at all. Why? Because they didn't understand the thresholds. Let me explain how this works. Centrelink sets asset thresholds. These change from time to time, so I won't give you exact numbers today, but the principle stays the same. There's a lower threshold below which you get the full pension, and there's an upper threshold above which you get nothing. And then there's the taper rate. For every dollar you have in assets above that lower threshold, your pension reduces by a set amount per fortnight. It's not one-to-one, but it adds up quickly. So let's say you're a homeowner couple. You've got your house, which is exempt, but you've also got $300,000 in superannuation, maybe $50,000 in a savings account, a car worth $20,000, some shares worth $30,000. Suddenly, you're at $400,000 in assessable assets, and depending on where the thresholds sit, that might reduce your pension significantly or eliminate it entirely. And here's where people make the mistake. They don't plan for this. They don't structure their assets strategically. They just let everything sit where it is, assuming they'll get the pension because they're not wealthy. But wealthy is defined by Centrelink's thresholds, not by your own sense of what wealth means. Some people have too much in cash. Cash is assessed at its full value. But there are other assets, other structures, that might be assessed more favorably. I'm not going to give specific investment advice here, but the principle is this. Where you hold your money matters just as much as how much you have. And some people make the opposite mistake. They deliberately give away assets to get below the threshold. They gift money to their children. They sell property at below market value to family members. They think they're being clever, but Centrelink has gifting rules, and those rules are strict. If you gift more than a certain amount in a financial year, or more than a certain amount over 5 years, Centrelink treats that money as if you still have it. It's called a deprived asset, and it still counts against you for 5 years. So you've given away the money, you can't access it anymore, but it's still reducing your pension. That's a disaster. That's mistake number 1 in its most painful form. The solution? Understand the asset test before you retire. Get advice. Model different scenarios. Know where you stand. Because once you understand it, you can plan around it. You can make informed decisions. And you can avoid giving away your financial security by accident. Mistake number 2. Misunderstanding deeming rates. Now this one's a bit technical, but stay with me. It's important. Deeming is how Centrelink calculates the income from your financial assets, and it catches a lot of people off guard. Here's how it works. Let's say you've got $100,000 in a savings account. In today's environment, that might be earning you, let's say, 4 or 5% interest, so that's $4,000 or $5,000 a year in actual income. But Centrelink doesn't care what you're actually earning. They use deemed rates. They say, we're going to assume your financial investments are earning a certain percentage, regardless of what they're really earning, and we're going to assess that deemed income against your pension. Now, why do they do this? Because otherwise, people would just hide money in assets that don't produce income. You'd put everything in gold or artwork or non-income producing investments and claim you have no income. Deeming prevents that. But here's the problem. The deemed rates don't always match reality. Sometimes the deemed rate is higher than what you're actually earning, so Centrelink is assessing you as if you're earning more than you really are, and that reduces your pension more than it should based on your real circumstances. Let's use an example. Imagine you're 64, you're tired, you've had enough of work, you want to retire. You've got super, you've got some savings, you think, I'll retire now, draw down my super, and then apply for the pension when I turn 67. Sounds reasonable, right? But here's what happens. In those 3 years between 64 and 67, you're drawing down your super, you're spending your savings. By the time you reach pension age, your assets have dropped. That's good for the asset test, but now you've got less money overall. And if you'd planned differently, you might have preserved more of your savings and still qualified for the pension. Or here's another scenario. You retire at 60, you access your super, you travel, you renovate the house, you help the kids with their home deposits. By the time you're 67, your super is much lower than it was. You qualify for a higher pension, yes, but you've spent a huge chunk of your retirement savings in those 7 years, and now you're more reliant on the pension than you needed to be. The timing of your retirement affects everything. When you access your super, when you sell investments, when you claim the pension, when you downsize your home. All of these decisions interact with each other, and if you do them in the wrong order, you can end up worse off. Let me give you an example. Let's say you own an investment property. You're planning to sell it to fund your retirement. If you sell it before you retire, you might trigger a large capital gain. That's taxable income, and it might push you into a higher tax bracket. Plus, the proceeds from the sale become assessable assets for Centrelink. But if you sell it after you retire, when your income is lower, you might pay less tax on the capital gain. And if you're strategic about when you do it, you might be able to manage the impact on your pension assessment. Or consider this. You've got $200,000 in super. You could take it all out as a lump sum at 60, or you could leave it in super and draw an income stream from age 67. The second option might be better because income from super after 60 is usually tax-free, and it's assessed differently by Centrelink. The mistake is rushing. It's not planning the sequence of events. It's making big financial moves without understanding how they ripple through your entire retirement strategy. The solution? Map it out. Talk to a financial advisor before you retire, not after. Look at different scenarios. What if you retire at 60, 65, 67?
What if you sell the investment property now versus in 3 years? What if you keep working part-time instead of retiring fully? These questions matter, and the answers can mean the difference between a comfortable retirement and a stressful one. Mistake number 4, not reporting changes to Centrelink. This one seems simple, but it trips people up constantly, and it can have serious consequences. When you're receiving the age pension, you have obligations. You must report any changes to your circumstances: new income, sale of assets, inheritances, changes to your living arrangements, even going overseas for an extended period. All of it must be reported. And here's where people make mistakes. Sometimes it's innocent. They don't realize something needs to be reported. Sometimes it's forgetfulness. They mean to report it, but they forget. And sometimes, unfortunately, it's deliberate. They don't report because they're worried their pension will be cut. Let me be very clear about this. If you don't report changes and Centrelink finds out, and they will find out, you'll have to pay back any overpaid pension. All of it. Plus, you could face penalties. In serious cases, it's fraud. It's a criminal offense. I know that sounds harsh, but Centrelink has data matching systems. They talk to the tax office. They know when you sell property. They know when you receive an inheritance. They know when you start earning employment income. The information catches up with you. So let's talk about common scenarios where people fail to report. You inherit money from a relative, $50,000. You think it's a one-time thing, I don't need to report it. Wrong. That's now an assessable asset. It needs to be reported within 14 days. You sell your car and buy a cheaper one. You've got $10,000 left over. You put it in the bank. You think it's just car money. It doesn't matter. Wrong. Your assets have increased. It needs to be reported. You start doing some casual work, helping a friend's business, getting paid cash, a few $100s here and there. You think it's not much. It won't make a difference. Wrong. It's employment income. It needs to be reported. Your adult child moves back home. They're paying you board. You think they're family. It's not real income. Wrong. Board payments can be assessable income. It needs to be reported. Do you see the pattern? People make assumptions. They decide for themselves what's important and what's not. But that's not how it works. Centrelink decides what's reportable, and their definition is broad. Now, I understand the fear. You report something and your pension gets cut. That feels like punishment for being honest. But here's the reality. If you're entitled to less pension because your circumstances changed, you're not entitled to the higher amount.
Keeping it is not your right. It's an overpayment, and it will be recovered. The better approach? Report everything. Be transparent. Yes, your pension might reduce, but it will be the correct amount, and you'll sleep at night knowing you've done the right thing. No stress, no fear of a debt notice arriving in the mail, no risk of fraud charges. Plus, here's something people don't realize. Sometimes reporting a change can actually increase your pension. Maybe your assets dropped in value. Maybe your income reduced. If you don't report it, you're missing out on money you're entitled to. So make reporting a habit. Set reminders. Keep records. When in doubt, report it. Centrelink would rather you over-report than under-report. They can tell you if something doesn't matter, but they can't help you if you hide things. Mistake number 5, not claiming everything you're entitled to. This is the saddest mistake of all, because it's not about doing something wrong. It's about not knowing what's available. It's about leaving money on the table that could make your life easier. The age pension is not the only benefit available to retirees. There are supplements, concessions, health care cards, energy rebates. Depending on your state, there are transport discounts, rate reductions, pharmaceutical allowances, and more. But most people don't know about them, or they assume they don't qualify, or they think it's too much effort to apply. So they miss out, month after month, year after year. Let me give you some examples. If you're receiving a part pension, even a small one, you're likely entitled to a Commonwealth Seniors Health Card or a Pensioner Concession Card.
These cards give you access to cheaper medicines, bulk billed doctor visits, discounts on utilities, public transport concessions. Do you know how much that's worth? For some people, it's hundreds of dollars a month. Over a year, it's thousands. Over a decade, it's tens of thousands, just by having that card and using the concessions. Then there's the pension supplement. It's a small fortnightly payment that comes on top of your base pension. It's designed to help with costs like bills and medicine. Most people receiving the pension get it automatically, but some people miss out because they don't realize they need to claim it, or their circumstances changed and they didn't update Centrelink. There's also the energy supplement. It helps with electricity and gas bills. Again, some people get it automatically, but others need to apply. And depending on where you live, your state or territory might have additional schemes. Seniors cards that give you retail discounts, rates rebates for low-income households, free or subsidized travel for pensioners, solar panel rebates, home modification grants if you need accessibility changes. But here's the problem. The system doesn't chase you. It doesn't say, hey, you're eligible for this. Would you like to apply? You have to know what's available. You have to take the initiative. You have to do the research. And most people don't. Most people are already overwhelmed. They're dealing with Centrelink for their pension, and that's hard enough. The idea of applying for 10 other things feels like too much, so they don't bother. But that's leaving money on the table. That's choosing to make life harder than it needs to be, and I don't want that for you. So here's what I want you to do. Go to the Services Australia website. Look at the Payment Finder tool. It will show you what you might be entitled to based on your situation. Then go to your state or territory government website. Look for seniors concessions. Make a list. Yes, it takes time. Yes, it's a bit of effort. But you're not doing this every week. You're doing it once, and then you're set. You'll have access to benefits that will save you money for years to come. And don't be shy. Don't think, oh, that's for people worse off than me. If you're entitled to it, claim it. You've paid taxes your whole life. This is part of the social safety net you contributed to. You've earned it. Now, let me bring this to life with a story. Let me tell you about Bruce and Jenny. They're not real people, but they represent a situation I see all the time.
Bruce and Jenny are both 68. They've been married for 40 years. They worked hard. Bruce was a plumber. Jenny was a school administration officer. They own their home outright, no mortgage. It's a nice 3-bedroom place in the suburbs worth about $800,000. They've got superannuation. Bruce has $250,000. Jenny has $180,000. They've got $30,000 in a savings account for emergencies. They own their car outright, and they've got a small share portfolio worth about $40,000 that Bruce's dad left him years ago. On paper, they're comfortable. They're not wealthy, but they're not struggling, and they assumed they'd get the age pension. Maybe not the full amount, but something. So Bruce applies for the pension at 67. He fills in all the forms, he declares everything, and then he waits. A few weeks later, he gets a letter. He's entitled to a part pension, about $300 a fortnight, less than he expected, but okay. Jenny applies at the same time. She also gets a part pension, about the same amount. So together, they're getting around $600 a fortnight from Centrelink. It helps, but it's not much. Now, here's where the mistakes come in. Bruce and Jenny made 3 of the 5 mistakes we've talked about, and it cost them. Mistake 1, they didn't understand the asset test. They have $470,000 in assessable assets, not counting their home. That's the super, the savings, the car, the shares. All of it adds up. And because they're just over the threshold for a higher pension, they're in the taper zone. Every dollar they have is reducing their pension by a set amount per fortnight. But here's the thing. They didn't need $30,000 in a savings account. That's too much for an emergency fund. They could have used some of that to pay off a few debts, make some home improvements, or even prepay some bills. All of those things would have reduced their assessable assets without wasting money, but they didn't know to do that, so they're sitting on cash that's reducing their pension. Mistake 2, they didn't understand deeming.
Their savings account is earning about 4% interest. That's $1,200 a year. But Centrelink is deeming their total financial assets at a higher rate, so they're being assessed on more income than they're actually earning. That's reducing their pension further. If they'd understood deeming, they might have structured their assets differently. Maybe put some into their super, where it's assessed differently. Maybe allocated their investments to take advantage of deeming thresholds. But they didn't know, so they're losing out. Mistake 3, they're not claiming everything they're entitled to. Yes, they're getting a part pension, but they didn't apply for the seniors card in their state. They didn't realize they could get energy rebates. They didn't know about the rates rebate their local council offers. Together, those concessions could save them $1,000 a year or more. And here's the heartbreaking part. Bruce and Jenny are good people. They followed the rules, they saved, they planned. But because the system is complicated and because they didn't get advice, they're not getting the best outcome. They're leaving money on the table, and they don't even know it.
And they'd say, make sure you're claiming all your concessions. Here is a list. Apply for each one. It takes a few hours, but it's worth it. Do you see the difference? It's not about gaming the system. It's not about hiding assets or being dishonest. It's about understanding the rules and working within them to get the best outcome. It's about being strategic. Bruce and Jenny didn't do that, and it's costing them, not because they're bad at money, but because the system is complex and they didn't know they needed help navigating it. So what's the lesson here? Don't be Bruce and Jenny. Or rather, if you are Bruce and Jenny, don't stay Bruce and Jenny. Get help. Get advice. Understand your situation before you lock it in, because once you're on the pension, it's harder to unwind mistakes. Now, let's talk about solutions. Let's talk about what you can actually do, starting today, to avoid these mistakes and to make sure you're getting every dollar you're entitled to. Solution 1. Get educated. You're doing that right now by listening to this, but don't stop here. Go to the Services Australia website, read the age pension guides, understand the asset test, understand the income test, understand deeming. Yes, it's dry, yes, it's boring, but it's your money. It's worth the effort. You don't need to become an expert, but you need to understand the basics. You need to know enough to ask good questions. You need to know enough to spot when something doesn't seem right. Solution 2. Get advice. And I mean proper advice, not just a chat with your mate down at the bowls club, not just Googling things. Sit down with a licensed financial advisor who specializes in retirement planning and Centrelink. Yes, it costs money, but it's an investment. A good advisor can save you far more than they cost. Look for someone who charges a fixed fee for advice, not someone on commission. You want someone whose interest is aligned with yours, someone who will look at your whole situation and give you a clear strategy. And don't wait until you're already retired. Do this a year or two beforehand. That gives you time to restructure things if needed. That gives you time to make strategic decisions. Once you're already on the pension, your options are more limited. Solution 3. Model different scenarios. This is something your advisor can help with, but you can also do some of this yourself. There are online calculators. Centrelink has them. Financial planning websites have them. Plug in your numbers and see what happens. What if you retire at 60 versus 67? What if you sell your investment property now versus later? What if you draw down your super faster versus slower? What if you downsize your home? All of these decisions affect your pension. Model them before you make them. Solution 4. Keep excellent records. I can't stress this enough. Keep every payslip, every bank statement, every super statement, every contract of sale, every dividend statement, everything. Because when you apply for the pension, you'll need to prove everything. And if Centrelink ever questions something, you'll need documentation. Plus, keeping records helps you stay on top of your obligations. If you've got a folder where you put everything, it's much easier to remember what needs to be reported. It's much easier to see when something's changed. Solution 5. Report everything and report it promptly. Make this your golden rule.
When in doubt, report it. Don't wait. Don't procrastinate. As soon as something changes, update Centrelink. Use the app. Use the website. Call them, whatever it takes. Yes, it's annoying. Yes, you're busy, but it's not optional. And doing it promptly protects you. It means you'll never be hit with a surprise debt. It means you'll always be getting the right amount. And it means you'll sleep soundly at night. Solution 6. Claim everything you're entitled to. Sit down this week and make a list. What concessions are available in your state? What supplements can you claim? What cards should you have? Then systematically apply for each one. Set aside a few hours, make it a project, tick them off one by one. And once you've got them, use them. Keep your senior's card in your wallet. Ask for discounts. Use bulk billing. Take advantage of free public transport days. These benefits exist to help you. Let them.
Solution 7. Review your situation regularly. Your circumstances change. The rules change. Thresholds change. So don't just set and forget. Once a year, sit down and review everything. Look at your assets. Look at your income. Look at your pension entitlement. Make sure it's still accurate. Make sure you're still getting the best outcome. And if something's changed, adjust. Maybe you need to restructure something. Maybe you need to report something. Maybe you're now entitled to something new. An annual review keeps you on track. Now, I want to address something. Some of you might be thinking, this all sounds like a lot of work. And you're right, it is. But here's what I want you to remember. This is your retirement. This is the money that will fund the next 20 or 30 years of your life. It's worth the work. Think about all the years you spent working, all the early mornings, all the long days, all the stress. You did that to build your retirement savings. Are you really going to let it go to waste now by not managing it properly? Are you really going to leave thousands of dollars on the table because you couldn't be bothered filling in a few forms? I don't think so. I think you're better than that. I think you understand that this matters, and I think you're willing to put in the effort to get it right. Plus, here's the good news. Once you set things up properly, it gets easier. The hard work is at the beginning, understanding the system, restructuring your finances, claiming your entitlements. But once that's done, it's just maintenance. It's just keeping an eye on things and reporting when needed. That's manageable. And the payoff is enormous, not just financially, although that matters, but emotionally. The peace of mind of knowing you've done everything right. The confidence of knowing you're getting every dollar you're entitled to. The security of knowing you've got a plan and you're sticking to it. That's priceless. So let's bring this home. Let's talk about what this is really all about. Because yes, we've spent 30 minutes talking about Centrelink rules and asset tests and deeming rates, but that's not what this is really about. This is about your life. This is about the third act. This is about the years you've earned, the years you've dreamed about. You've worked hard. You've raised families. You've contributed. You've paid your dues. And now, finally, you've reached the stage where you can step back, where you can breathe, where you can focus on what matters to you. Maybe that's travel. Maybe it's spending time with grandchildren. Maybe it's pursuing hobbies you never had time for. Maybe it's volunteering. Maybe it's just enjoying quiet mornings with a cup of tea and a good book. Whatever it is, you deserve to enjoy it. You deserve to do it without constant financial stress, without lying awake at night wondering if you'll have enough, without checking your bank balance every day with a knot in your stomach. And that's what good financial planning gives you. It's not about being rich. It's about being secure. It's about knowing where you stand. It's about having a plan you trust. It's about removing the uncertainty so you can focus on living. Every dollar of pension you're entitled to is a dollar that supports that life. Every concession you claim is money you can spend on things that bring you joy. Every mistake you avoid is stress you don't have to carry. So I want to leave you with this. You are not a burden.
You're not asking for a handout. The age pension and the support system around it exists because society recognizes that you've contributed. You've earned this. It's not charity, it's part of the social contract. But to get what you've earned, you need to understand the system. You need to navigate it properly. And that's what I've tried to give you today. The knowledge, the awareness, the tools to avoid costly mistakes. Now it's up to you. You can take what you've learned here and act on it. You can get advice. You can check your entitlements. You can restructure if needed. You can report properly. You can claim everything you deserve. Or you can do nothing. You can stay where you are. And maybe you'll be fine. Or maybe you'll be Bruce and Jenny, leaving thousands on the table without even knowing it. I hope you choose action. I hope you choose to take control, because you deserve the best possible retirement. You deserve every dollar you're entitled to, and you deserve the peace of mind that comes.